Ginzo VI! Onegai shimasu! Okay, welcome back to the series. In this video, we're gonna have a look at how I value a company. So more specifically, I'm gonna tell you how I do my own version of discounted cash flow analysis. Personally, I like to use the discounted cash flow to equity. So I'm going to show you how I do that. I'm also going to show you the assumptions that I have when doing, or that I make when doing evaluation. And in the end, I'm going to tell you about a few, how to tie up some loose ends that you usually don't see when people do discounted cash flow valuations. Then next, I like to compare my own valuation against a spreadsheet which is made available by Professor Damodaran. Professor Damodaran, if you don't know him, he's kind of considered the guru of valuation. I'll leave a link in the description below with his YouTube site. I mean, absolutely amazing. Professor Damodaran is amazing. He makes an entire MBA course on valuation for free in his channel. So please check it out. It's really worth the effort and the time. And so I will be comparing my own valuation against the evaluation that I get from Professor Damodaran's spreadsheets. And then last but not least, I'm going to tell you about how I take all this information and how I assess my confidence in my valuation. And that reflects in the margin of safety that I put in against each one of my valuations. Okay, so let's do this then. Okay, so in the last couple of videos, I've shown you how I analyze the finances of a company, kind of look at their growth over time, their cash flows over time. And also in the last video, I kind of told you how I validate a stock, right? So most of this information is going to be very useful now for us to do a valuation of the business. So there's two main types of valuations. One type is called the discounted cash flow valuation, and that's actually the one that we're going to use today. There's different types within the discounted cash flow. There's the dividends discount cash flow. There's the cash flow to equity discount model, and also the cash flow to the firm discount model. So we're going to use the discount cash flow to equity. That's the one that I found more useful to us. I don't want to go into the details of the mathematics behind the discount cash flow model. I mean, you can find that information pretty much out there in the web, in different websites. I think that it's not rocket science. Anyone with a basic knowledge of arithmetics can do that. But pretty much is to, in order to value a business based on a discounted cash flow, in our case, cash flow to equity, we are going to project the revenues and the cash flows from those revenues into the future, okay? And then we're going to discount it back to the present and get the present value of the company, okay? So it sounds more difficult than actually it is. So I'm just going to show you. And by the way, you have access to the spreadsheet. There's a link in the description below where you can find this spreadsheet. Just feel free to use it as it is. Feel free to make adjustments. I'll show you as we go along how easy it is, right? So the fields that you have to input in these spreadsheets are colored in yellow, okay? Those are the ones that you need to fill in. The first one is just the last year's revenue. Okay, so again, if we go back to our previous performance tab, where I showed you all the financials, which I took pretty much out of the Morningstar website, okay, and I put it into here so that I can have a visuals of what's going on. This is the figure we want. We want the total revenue from the last fiscal year, which is 2020. Okay, so we're going to copy this value into this first field here, C3. Okay, as you can see, it starts projecting the revenues into the future, 5 years into the future. Now, there's people who project revenues over 10 years. I prefer to project only 5 years. I mean, it's difficult enough to guess what's going to happen next year or 2 years from now, let alone think of what's going to happen in 10 years. So I would rather just project to 5 years, and then after that, I will assume that the company will still grow, but it will grow at a rate of the normal economy, which is 2%. And that's actually the figure that you see here on row 13, perpetual growth free rate. That's 2%, because that's in line with what a modern economy grows in the Western world. Okay, so now that I've inputted the revenue from 2020, I'm gonna estimate what's going to be the growth in the next 5 years. Okay, so in order to do that, what I'm going to do is to look at the past performance of Intel. Okay, so last year they grew from the previous year at a rate of 8.2%. Okay, however, before that they only grow in 1.6% from 2018 to 2019. I'm talking about the revenues. Okay, so because I have this data here, I've computed this data, I can actually look at the average of growth over the last 10 years, which is 4.2%, but I can also look at the growth in their revenues over the last 5 years, which is 7.1%, and I can also look at the growth over the last 3 years, which is 7.55%. Okay, now this is where you have to come up with assumptions. Okay, and based on these historical performance, my assumption is that Intel will keep on growing, okay, and I'm going to assume that their growth over the next 5 years is going to be 6%, okay. Now, if you think that, for example, next year they only going to grow at 4, and then 5, and then 6 for the remaining 3 years, that's fine, okay. You can input those, you can make those changes in the revenue growth in any of these years. But in all honesty, I don't think that's necessary. I think that if we assume 5 years is not that of a long stretch, so I'm going to say that on average, I expect Intel to grow at 6% of their revenues year on year over the next 5 years. Okay, that's good enough for me. It's a good assumption. It's not too conservative. It's not too optimistic. Okay, it's in line with the long-term average they have. Okay. Now the next input is the operational cash flow. Again, this is something that comes straight off the financials. I have it already here because I took it from the Morningstar website, and it's here. Last year, Intel generated 35.3 billion in revenue. In cash flow for operations, or operational cash flow. So the only thing I have to do is to copy this information onto this cell of the spreadsheet, right? Now, as soon as I do this, this comes up with a number here, the 45%. 45% is the ratio of operational cash flow to revenues, okay, which in 2020 was 45%, I will need to input what's going to be my estimate for that ratio, operational cash flow to revenue, over the next 5 years. And if I want to do that, I can again come over here, and I've already computed the 10-year average, which is 39%, or 38.5%. I can also see the last 5 years, which on average had a ratio of 41%, or even in the last 3 years, which had a ratio of 45%, 44.3. Okay, so I think that that's not going to change a lot in the next coming years. Okay, so I come over here and I say, all right, for the next 5 years, my assumption is that the operational cash flow to revenue ratio is going to be, somewhat standard, right? So it's going to be 45%. Okay. The next in line is free cash flow. Once again, this is a figure that is given to you by the financial statement. Right? I already have it here. I'm just going to copy this. It was 20.9 billion last year of free cash flow, right? And I'm going to input it in this cell here. Again, it gives me the ratio of free cash flow to operational cash flow of 59%. Just want to check against the average over the last 5 years, and I see that over the past 10 years the average was 50%. Over the last 5 years the average was 52%, and over the last 3 years the average was 52%. Okay, last year was slightly higher, so I am going to take a conservative approach here and say that in the next 2 years it's going to go again back in line with the historical average, which was 52%. Okay, that's what I'm going to estimate, that the free cash flow ratio to operational cash flow is around 52%. Okay, all right. Okay, so with all this, the Excel gives me a fair business value of 443 billion. Okay, this is assuming a required rate of return of 7% on my investments and a perpetual growth or free rates of 2%. Okay, now this is not the end of the story. This is not how much the business is worth for investors. This is just the expected cash flows at the present value. Okay, we need to do a little bit of tying up on this number. Namely, we need to deduct the current debt, long-term and short-term interests bearing debts. We need to add the cash and marketable securities, and we also need to take into account any cross holdings or other non-operating assets. Okay, for this we now need to go into the balance sheet. Okay, so if we jump into Morningstar, go into the financials and look at the balance sheet, make sure that we have the correct year. So the first one, if you remember, that's debt. I want to get the short-term debt from the last year. I want to put it into here. Okay, but also I want to add the long-term debt, right? So those are the liabilities, interest-bearing liabilities that the company has. And that subtracts to the fair business value of all the cash flows. But now we're going to add all the cash and marketable securities that the company has on their balance sheets. And that number comes from here, total cash. Okay, we copy total cash and we put it into here. Okay, because at the end of the day, that is money that belongs to the shareholders. It belongs to a company which, belongs to the shareholders, right? And then last but not least, that's cross-holdings and other non-operating assets. Now, we could do two things. We can just simply come over here to the balance sheets and take that value out of the other long-term assets, which is what I'm going to do. Or if we want to be really, really pedantic, we would need to go into the financial statements and have a look of what is within these other long-term assets and kind of filter the ones that are not really assets that can be transformed into cash in the case the company is diluted, okay, and all the cash is returned to the shareholders, something that it's not going to happen. So rather than having that triple work, double work, I'm just going to take this number on its value, and it's also not a significant amount compare with the rest. So that was, apologies for that, that was that's the figure I want, 4 billion, 4.6 billion into here. No, there we go. Okay, right. And then last but not least, the last thing we need is to go back to the key ratios and get the outstanding shares, which is this value here. Now again, if you want to be really precise, you would need to go to the financial statement and take the common stocks available, because that changes over time as companies issue or purchase stock through their buybacks. But I'll take the value out of here. Morningstar tends to be really reliable in terms of these figures. So rather than having to drill down through the financial statement from last year, I'm just going to take this value here, okay? All right, and we'll put it here in the last yellow cell that's empty yet. Okay, and then I get to fair value of shares. Okay, that's it. So according to my model, according to the assumptions that I've made of growth and operation cash flow to revenue and free cash flow to operation, okay, and taking into account the debts, the cash and marketable securities, cross holdings, I get to a fair value per share of $102, right? Now, I have absolutely no idea what is the price of that stock today, okay? In all honesty, I don't care. I don't care at this moment in time. I will care in the next video, but at this moment in time, I don't care what is the price. I know that according to my model, according to my simulations, a fair price for Intel would be around $102. Okay, now I'm not sure if my value is right or how right it is. Okay, so I like to do another step that allows me to compare my value with something else, right? And that something else is Professor Damodaran's spreadsheet. Okay, so if you don't know Professor Damodaran is kind of considered the guru of valuation. Okay, I'll actually put a link in the description to his website and his YouTube page. In his YouTube, you'll find a lot of videos and courses on valuation, including a full-on MBA course on valuation. So really worth watching, really worth your time. So have a look there. But Professor Damodaran also provides a spreadsheet, right, to calculate the value of a company. It's a more complex spreadsheet. It takes into account things like R&D, things like lease commitments, and so forth and so on. So I'm not going to go into much detail on this spreadsheet. Okay, I spent a couple of days trying to sort it out. Quite complex, but once you understand the basics, it's pretty simple to use. And what I usually do is that while I still rely on my valuation for a fair price, I like to check against the value that Professor Damodaran's spreadsheet provides me with. Okay, and in the case for Intel, which I did an assessment last month, his spreadsheet was giving me $89 for Intel. Okay, so I'm gonna copy this value here, and I'm gonna put it here just next to my value. Okay, kind of have an idea on how wrong can I be. Okay, and well, how wrong can I be? I can be wrong. I'm saying that actually is worth 102, while Professor Damodaran's spreadsheet is saying that it's only worth 90. So I could be wrong by $12 a share, which is significant, right? Sometimes I double check my figures. So in this case, for example, I double check my assumptions. Again, his assumptions, I assume 6% growth over 5 years. In this spreadsheet, I'm only assuming 4% in the first year or so. So if I go to my spreadsheet, I'll say, all right, fair enough, let's compare apples with apples. And I do 4% only, I get to a valuation of 100, still $10 difference between his valuation and my valuation. But hey, it is what it is, right? There's two different models here to compare. Two different people will have different results. Two different models will get two different results. I'm more concerned about how big is the gap between those two values, right? And in this case, okay, that would help me to get a margin of safety on my value. Okay, so if the two values were very, very close, okay, I would probably go for a margin of safety of 20%. I'll explain margin of safety on the next video, but that's the value that I would be willing to buy, given a risk. Okay. So as I was saying, if the two values are very similar, I would probably go for a margin of safety of 20%. If in this case, I would probably go for a margin of safety of 30%. Okay, so meaning that I would be willing to buy a share if it was 30% lower than $100. Okay, so I would buy a share at $70. Okay, I would consider worth buying an Intel share if it was at $70. Okay, that would be my margin of safety. So that's basically why I compare my value against Professor Damodaran's spreadsheet value to get to a margin of safety that I'm comfortable with. Okay, I think this is all for today. I hope you guys understood my method to get a valuation. If you have any questions or if you have any suggestions, just comment below. I'm more than happy to provide you some additional feedback on anything that is not clear on this type of valuation. So thank you very much, and see you soon. Okay, so far we've seen how I screen for value. I kind of showed you the tools that I use and the metrics that I use to screen for value. I also showed you in the second video how I analyze the financials of a company. And in the third video, I showed you how I validate a specific business. In this video, we covered the business valuations and how I use my own tools and compare against the tools from that Professor Damodaran provides. And then in the next video, I'm going to tell you about how I make my buying decisions and the sort of rules that I use to manage my portfolio. So thank you very much. If you like these type of videos, please give me a thumbs up. That will tell me that it's people out there that takes value out of my videos, and gives me enough energy and confidence to keep on doing these videos. Also, if you want to be notified on the upcoming videos in this series, click the subscribe button and the bell icon, and you'll get a notification when I upload the next video. So, that is all for now. Thank you very much. Stay safe out there. Kinzo vi! Arigato gozaimashita!